This week, we're taking a look at the Catalyst Global Property Fund, taking a look at the managers there, of course, Catalyst Fund managers. The formation date, November 2007. Fund size, $192 million. The objective is the UBS Global Real Estate Investors Index, TR sitting at 1.8%. So there we go. Those are the fund factors they stand right now. Cobie, take us through the returns.
Okay, well, I mean, again, we need to understand the returns here in relation to its global, obviously its global mandate, because it's got no assets onshore. It's all literally global assets. So have a look at these returns. They're all in dollars and they're all based obviously globally. Look at that table over there. 12-month return 15.6 versus the real estate investors index now to 19.2. I mean, obviously here the returns here as up to the end of February 2013. And you can see the 24-month return there, 3-year return, 15.5 versus 17, and then 60 months versus 21 versus 20.5. I mean, one of the things to take into consideration here is if you take the track record up to the end of December, you've got outperformance literally against over all the periods against the benchmark. And literally over the last 2 months, they've given back some of that, and they're busy regaining some of that again as of March. Just have a look quickly at what the rolling 12-month returns look like. And I mean, this will be a chart that you're obviously used to. And it will show you the rolling 12-month returns. You see obviously very decent outperformance relative to the benchmark in a space such as this, and obviously a fairly decent track record over time, as you can see there. And and the red line will indicate the rolling 12-month returns and that's for the benchmark. The UBS.
So let's take a look at the geographic allocation, Roland. What are your thoughts on that?
Yeah, I'd like to ask Jamie, how would your sort of allocation look different to your competitors or your peer group? In other words, where do you see the opportunities? We can see that you have a huge allocation to the United States, which you've explained early on is where there's a lot of recovery potential. Is that sort of the biggest position that you have relative to the competition?
We also look at things obviously relative to where the benchmark is. So, I think if you had to look at that pie chart 12 to 18 months ago, it would have looked a lot different. We actually went into 2012 significantly underweight the US. We were probably about 10% underweight the US and about 10% actively overweight Asia, and specifically in Singapore and Hong Kong. And those calls worked very nicely for us. I mean, Singapore and Hong Kong were obviously really strong last year, and the US was relatively weak, doing about 18% versus the benchmark of 23. So as the year went through, the relative value positions in the stocks obviously moved closer to each other as Asia outperformed the US, and towards the end of last year we actually moved to neutral North America.
And how do currencies come into this? Because could the volatility of currencies wipe out your returns or your yields from the properties?
They could. I mean, how we deal with it is we feel that our required rate of return is built up off the 10-year government bond in each region. So if a company owns properties in Japan, for example, we will build up our required rate of return for that, the valuation of that stock from the Japanese 10-year government bond.
So in essence, Jamie, do you hedge against
deal with
currency
risks involved?
Yeah.
We don't hedge against currency risk. We do have the ability to do it, but to date we've never done it. And the other thing to bear in mind is that you can't please everyone, but a lot of people like the diversity of the different currencies. So the benchmark has got different currencies in it, so naturally it's going to move around with how those currencies work, and likewise the fund's going to do the same.
Yeah, and just looking at, the currency exposure, just for anyone who's interested, 58, almost to 60% is to the US dollar right now, and the Australian dollar 12.5%, and the euro sitting at 8.5%. That's the currency exposure as it stands right now of this property fund. But also when it comes to sectors, we also have to take a look at the sectors that you're invested in right now. What's your asset allocation? Have you been changing asset allocation to the various sectors? Take us through that, Jamie.
Yeah, I think at the moment the sectors that we really like are the dominant regional malls in the US. That pie chart I think has just got retail as a whole. In the US it's pretty much split into the malls and then the strip centers. Strip centers are generally of the lower quality asset type I was talking about earlier, whereas malls are of higher quality, very hard to replicate, and as a result higher sustainable growth in our view. There's been a bit of a rally in higher yielding stocks, what we feel are lower quality portfolios. So your strips being one of those, strips centres. Industrial has been pretty strong, and we feel it's been a bit overdone. So we actually think the higher quality assets are very attractively priced compared to what we consider to be lower quality type assets are at the moment. So overweight regional malls, overweight apartments. The US is the major market that's got exposure to apartments.
Yeah.
So these are apartments that that the companies own to rent out. On the underweight side, underweight industrial, we feel it's run pretty hard. It's a market that can quite quickly be oversupplied, and as a result, there's always a bit of a cap on where market rental growth can go, because as market rental growth starts to come back, guys just develop more space, and as a result, tenants have got more optionality, and it just keeps a natural cap on where rentals can be.
Jamie,
office markets are also very cyclical.
We've got a minute left, and before we end off the show, I just wanted to get a view from you in terms of what you're expecting from the global property market for the next, say, 5 years. If you could just run us through that and why it's important to get offshore exposure right now.
The sector at the moment's priced at about a forward earnings yield of about 5%. So, given where fixed income products are at the moment, that's pretty attractive. In addition to that, I think what people who don't follow the sector closely might surprise them is that growth is actually pretty good for the next 4 to 5 years. As I spoke to earlier in the show, fundamentals are good, funding costs are very low, there's very little supply, so that even though demand for space is not radically strong, there is some market rental growth in most sectors and regions. So there's actually pretty good growth happening at the moment, and a lot of leases in the next 3-4 years are coming off rents that were struck in 08, 09, 2010, very weak markets. Those rents have obviously recovered, and as you reprice those leases, there's obviously some room for growth. So pretty good growth in the medium term, and then in the long term, I think inflationary type growth. So if you can enter the market at a 5% yield and get sort of 5 to 6% growth over the medium term, and sort of inflationary type growth over the long term, I think it's a pretty attractive risk return investment proposition at the moment. I mean, we're seeing the sector do about 9% in US dollars for the next 5 years. What we're thinking it will do, and I think that given the current slow economic environment, I think that's pretty attractive.